Thank you. Hey everyone. I wish my mic was on when I was back there because we had some really good stuff. We talked about the Who for a little bit. We talked about the New York highway system, and now I get to talk about insurance. So you guys are you're in a good place. This is super exciting. But I'll make it as exciting as I can. I spent 22 years in insurance, and today I was going to talk about what Nimble is, what we're doing at Nimble. And I kind of got the vibe after everything we've been going through with FTX and with all the markets to talk about really what we're doing here and to rethink or remind ourselves what we're doing and why we're building, right? So we have this little doodle here to represent the Nimble world. And for us, this is what it feels like in the current state of insurance. It's crowded, it's not happy, that poor little Nimble person is being rained on. And I just want to talk about today, what are we building, right? As a community of people, there's a lot of people here. And I was at Decipher last year, there's a lot more people this year. That's a good thing. That means we're all trying to build something, but why are we building it? What is our ultimate goal? And then, how are we going to get there, right? So we're talking about building a world that is expansive, that's inclusive, that builds on actually, an expanding universe. But we're trying to build this to be building community, right? To move through. Oh, my animations aren't working, so that just looks like crap. But anyways, we're building a bigger community, right? Together. I always say that the biggest challenge building on Web3 is the opportunity, which is a great challenge to have, right? The challenge that there's partners that we can build with and we can work together to leverage these new technologies. And to do that, though, we need users. We don't need to keep scaring users away. And that's one of the main problems I see, right? And we call this the disincentive loop. So in insurance, the disincentive loop is this whole idea that, first of all, it's insurance. So I don't have to tell you what the problems are because you feel them every day, right? There's this heavy regulation, which means it really stifles competition. Competition in insurance is, I increased my rates 3% and you increased your rates 2.8%, and now, you win, right? There's no incentive here for them to do anything different. The process is wildly confusing. You ask your agent, and I spent time as an insurance agent, you ask your company, how does this work? And you're going to get this kind of juggling act about what's happening. Ultimately, the inefficiencies that exist in all of that contribute to the rates. So if it's expensive to settle a claim and all that, that ultimately is being passed off to the consumer. So there is no incentive to adopt any new practices. That's a question I hear is why doesn't the insurance industry adopt technology in a broader way? Well, why? Well, they don't need to, right? So to me, it's similar to what's happening that we're seeing in blockchain, right? So there's this little quiz here, right? It's a $6 trillion industry plus, right? So is this insurance or blockchain? There's retail investor challenges. In insurance, you can invest in insurance if you're a retail investor. There's no way to do it. In blockchain, we're seeing that retail investors are willing to take this chance, but they keep getting kind of hammered for that. So nothing's happening here. Let me see if I can get it. There we go. Consumers pay the price and confusing processes. So for me, there's obvious similarities. The barrier to entry being challenging for this space. We talk about, someone on one of these panels said intelligent marketing, and I loved that because that's what we're trying to create here is a world that we can build together to create a system that works for everyone. All of this in insurance has led to what I call the satisfaction paradox, and it's the perfect example of insurance. This is a study from an insurance consultancy firm that they say 30% of insurance consumers are fairly satisfied, which is just BS because what that means is 70% are not. So 70% of insurance consumers are not happy with insurance. And 88% of them don't leave. So if 88% of all of us who purchase insurance don't leave and we're all unhappy, that tells you there's no option, right? So as an industry, we need to address this. And what can we do to stop that disincentive style loop from happening in blockchain? And for us, it's about creating an insurer chain, an insurance world where we can build on these partnerships, right? Where we can have it be more efficient, more flexible. For us in insurance, it's about creating a system where we're not cutting out the good parts of insurance. Underwriters, actuaries, insurance professionals work together. Ultimately, we have lower premiums as a result. We have a new asset class for people to invest in. So a retail investor can invest in the trillion-dollar investment opportunity that is insurance. And ultimately, everyone's working together to make that happen. And why does it work? And why does it work for everyone? If you look at, and I'm wondering if the animation isn't going to work here either, but if you look at a risk pool, let's think of a risk pool like a liquidity pool, and pick any asset. So for Nimble, our first insurance product is insurance for smart contracts. So the first thing that happens is these underwriters, actuaries, they can help develop the rates to make sure it's profitable. And the insurance premiums go into that pool. Now, LPs can also put money into that pool as an investment opportunity. So now you've created a situation where you have premiums in a risk pool and you have investment in a risk pool to pay claims. A portion of all of that is also redirected and allocated to what we call a Nimble common reserve. And the reason we do that is because we want diversification in the risk pools. So here's the Nimble ecosystem. That kind of cutout is one example of a risk pool, but those are all different asset classes that exist behind it, all of them contributing to the common reserve. So if one of those risk pools has a horrible year, it doesn't impact the profitability of the other risk pools, but there's also a way that if it's one of black swan event, there's money for them to leverage, which is similar to reinsurance in the traditional space. And the reason we do that is because 100% of the expected claims are paid by the insureds. So that means the premiums are modeled saying, as an insured, we expect the premiums to be able to cover the claims. There's two reasons. One is it's the most capital efficient way to do that. The other is if the expected claims are lower, insurers can actually take their money back. So this gives them an incentive to act responsibly. After that, say it goes beyond that, right? The next level of coverage is paid, a percentage is paid by those LPs. That means the LPs aren't the first line of defense. The LPs aren't saying, I'll take an 8% APY, but all my money's at stake right at the front. The rest of that is covered by the common reserve. And you'll see that as we keep going up this tower, there's multiple layers of protection. So you're getting a system here where you're protected, you're rewarded if you have a profitable year, and the LPs are protected, and there's traditional reinsurance there to further protect. So, whoops. Who contributes is as important as the contribution. I threw this in there because I firmly believe that whether you're a decentralized exchange, a centralized exchange, whether you're a foundation or a project, we all have a responsibility to contribute to a system like this. Because if we all contribute even, minimal amount of basis points, we're creating a better system. If we create a better system, we're bringing more people on chain, and we're realizing the vision that we set out to do. So part of that is working with partners so that we have a chain that not only does provide that protection, but provides it in a way that helps everyone and can recover. So if the assets are hacked from a smart contract, at Nimble, we're working with partners who leverage the same technology so that we can get those assets back, which ultimately benefits the entire community. There's a common thread here about working together, working together, working together. Ultimately, what we're creating is an insured world where the APY is real. It's based on the premium. It's based on the cost of capital. And the more profitable, the better. So we always say insurance is necessary, but it doesn't have to be evil. I also think blockchain does not have to sacrifice security. We're here because we believe in this technology, no other reason. At least I know that we are on the Nimble team. So I would say, and ask you, to just keep asking and reminding yourself, why are we building? And how can we all work together to make sure that we're still moving towards a more inclusive system that protects everybody and not just the few. So that's what we're doing at Nimble, and thanks guys for coming.